Let's bring in Dilin Wu now, research strategist at Pepperstone, joining us from Melbourne. Welcome to you, Dilin. So as I mentioned, Tesla and Alphabet will be reporting in the coming days. That's ahead of Microsoft, Meta, Apple, Amazon, the Magnificent Seven results. Are they going to convince markets, do you think, that the big AI bets are actually going to turn into profits?
Well, I think the AI CapEx story is still in the front of center and in this upcoming earnings season. And I mean, Alphabet comes in with serious momentum. Google Cloud backlog is quite massive, and that $80 billion equity raise in June with Berkshire putting in $10 billion tells you the conviction is quite real. I think the key number to watch for Google is obviously the margin. If cloud margins are expanding while CapEx is still accelerating, that's the proof the market needs. And for Tesla, I think is kind of telling a different story because deliveries were quite strong in Q2. Inventory is clearing. The operational story is quite fine, but what investors actually want to see is Elon Musk autonomous driving and robotics pivot showing up on the income statement, not only in his keynote speeches. So I feel like Tesla, the stock is down over 20% year to date. The market has been patient, but the patience has limit. So get both of these high, then the next week's Microsoft, Meta, and the rest of the Magnificent Seven's report become a victory lap.
Now, Deutsche Bank's highlighted AI, energy security and SOE reforms as tailwinds for the Chinese stocks. But what would it take for the CSI 300 and the Hang Seng to break out of what's been negative territory for the year?
Well, I think the structured supply in the AI trade in China is quite real. We have AI supply chain, energy security, SOE reform, etc. But the timing question is everything, basically. And right now, timing is working against China, I think. Three things actually break the market higher. First of all, consumption needs to show genuine life, not really PMI beats, but real retail spending. And that's tied directly to the property hangover, and it hasn't turned yet. And second, the PBOC needs to actually cut, not really talking about cuts. So with oil back above roughly $90 per barrel right now on renewed Iran tensions, the easing window is complicated. But the growth pressure is building, especially after Q2 GDP of China disappointed expectations. And three, we also need to see the geopolitical risk premium to compress because US-China trade friction and the renewed Middle East disruption both keep international investors cautious on Chinese exposure, if there's any. So I think the real trigger is probably a credible demand-side stimulus package, and the window for that is right now, so post Q2 GDP.
Dilin, Japan's Nikkei, South Korea's Kospi, they've advanced. Australia's ASX 200, the Chinese indices, they've dipped. What's driving this split in the Asia-Pacific markets?
Well, it's a great one, and it's actually a pretty clean story once you map it to different sector exposure. So I think Korea and Japan are up because chips are bouncing. The Philly semiconductor index rebounded from last week's sell-off. Samsung and TSMC are the biggest contributors to the MSCI Asia Pacific gain today. And Australia is flat to slightly negative, and that's commodity ambiguity problem. The Australia has a huge exposure to commodity price, and the ASX is heavy in energy and mining. Oil came off its peak on mediation news, but the underlying Middle East uncertainties means you don't know whether to price for disruption or normalization. So there are still a lot of uncertainty. And China's underperformance is more structural, as always. The Hang Seng had a rough end to last week on AI capex concerns and the widening discounts between Hong Kong and mainland listed shares. So I think there are a lot of uncertainty and volatilities in that market. That kind of divergence isn't going anywhere anytime soon.
Dilin, much appreciated the analysis there from Dilin Wu, who is a research strategist at Pepperstone.